There is a risk here that we rerun 98, 99 or 99 because you've just taken all the tail risk. Let's assume that Saudi, the US, and Israel do a deal with Iran. That feels like it's going to happen. Let's say that there will be a ceasefire in Ukraine, and let's assume that the Chinese will come to the table, do something reasonable. Those three things happen. We've taken all of the left tail off the table. And people are going to be like, oh, but inflation's going to come back. And they're going to keep saying that for 18 months, which they kept saying as inflation's fallen. So I think it is not a small probability that we have a really blow off kind of next 9 months or so. So, what I've done is built that framework of how crypto is just a macro asset. And it took a long time for people to believe that. They thought it's something different, it's something unique. It's a macro asset. So you apply the same things that I've always used, which is liquidity, business cycle, all that stuff, plus a bit of technicals and sentiment. There's no voodoo here. It's pretty straightforward as an asset. It's just more volatile. So it's harder to deal with. But you were right. What I was seeing was like the liquidity indicators like Global M2 had stabilized and started going up. It leads Bitcoin. Bitcoin was following it almost perfectly. So I was starting to look for the bottom. Then I start looking at stuff like, okay, where's sentiment on NASDAQ? Because it's tech stock, same thing. It was in the gutter. Right. Sentiment was the worst I had seen since COVID. That was across the board, across everything. Even hedge fund long short, everybody was max bearish. And I'm looking at liquidity. It's going up. I'm seeing the market getting fearful over a narrative. And I'm like, well, what is the likely outcome here? Are they going to have 150%, a trillion percent tariffs on China? No, they're going to reach something normal. So you've gone from peak headline fear to things could only be better from here. So for me, it was like a no-brainer of an opportunity, both in tech stocks and in crypto. And so going forwards now, normally speaking, this is the period, my framework is about, them rolling the debt and having to provide liquidity to do so. And so what we've got is a lot of forward-looking liquidity coming out of whether it's the weakness of the dollar, whether it's other countries using their balance sheets, a number of different mechanisms. And all of that to me is suggesting that the rest of this year is going to be very strong. And I was kind of thinking the NASDAQ was going to be a V-shaped recovery. And my God, it was a V-shaped recovery. And people are still underweight and short. It's a hell of a setup. We overlaid the chart of 1997, the Asian crisis, was a short, sharp shock, versus now it's almost identical. The kind of the 4 month period leading up to it, 4 or 5 months leading up to it. And that was a V-shaped recovery as well, because everybody was caught off sides because they thought the world was going to end. Liquidity came into the system. It was via the Fed that time cutting rates and all the other central banks. And the market just went up in a straight line for the next 2 years. There is a risk here that we rerun 98, 99 or 99 because you've just taken all the tail risk. Let's assume that Saudi, the US, and Israel do a deal with Iran. That feels like it's going to happen. Let's say that there will be a ceasefire in Ukraine, and let's assume that the Chinese will come to the table, do something reasonable. Those three things happen. We've taken all of the left tail off the table. And people are going to be like, oh, but inflation's going to come back. And they're going to keep saying that for 18 months, which they kept saying as inflation's fallen. So I think it is not a small probability that we have a really blow off kind of next 9 months or so. The last Trump cycle in 2017, we had the same thing. The market corrected in the beginning because everyone's fearing tariffs and the same narrative. The Fed were raising rates and doing balance sheet runoff. And the market screamed higher all year because the Chinese were stimulating, the Europeans had to stimulate. So it feels like, even if the Fed don't do anything, I still think the Fed cut, but let's assume they don't. Well, that's not a prerequisite for the market to do anything. As you said, as long as rates aren't jacking higher, everything's fine. No, it's real. And I'll tell you why it's real. I've just come back from the Middle East. All of the sovereign wealth funds are now buying. Right, these are the largest pools of capital in the world. We're hearing it out of Saudi, out of Abu Dhabi, out of Qatar, and out of Bahrain. And why that's happening is because the US has become crypto friendly. It's the green light. So the US will get some regulation through. There'll be a bit of a shit show and debating about it and the usual stuff, but they will get some regulation through, which is the clarity that all of the pension funds need. So they're waiting as well. So there is a lot of buying to come from the really big players who've been waiting. Like Goldman has not been able to fully build out its desk, and JP Morgan haven't. They've had crypto for a while, but only for certain types of customers. But they want to build out suites of product, but they've been waiting for regulatory clarity. So, yeah, I think it's a big deal. Like, the institutions are still either trying to figure out what this thing is. Yeah. Right? I had a conversation with one of the biggest kind of financial asset management firms in the world yesterday, based out of the US. And they're like, they've even got a crypto division, but they're other kind of where they allocate the assets. They're like, we don't know how to deal with this. So they're still trying to figure out what it is. Yeah. Like, they haven't figured out it's a macro asset. Others have. The sovereign wealth funds obviously just doing it for diversification of reserves. They're like, it's a technology, it's a diversification of reserves. So if the US is going to do it, we're going to do it. So there's different groups doing different stuff. There is a bunch of people who still don't really want to do the homework on it. They're like, we don't know, it's too volatile for us. But I think usually it's the first mover advantage in this. And, again, it reminds me a lot of back in the day when Goldman rolled out the GSCI index and nobody had commodities in their portfolios, and that team had to go around and sell commodities to everybody. And they would say, the clients would say, but it's too volatile. And you say, yes, but part of a diversified portfolio, it's exactly the same thing, right?
That's right. That's right.
Exactly. And also, we were around when the gold ETF started, and it's the same thing. Everyone was like, holy shit, where did this come from? It became a very, very big ETF. It's exactly the same. What people like to do, because there's so many new participants in the industry, they think it's all new and different. When you've been around as long as you and I, you realize nothing is different. We've gone through all of this before. This just happens to be a bigger, faster moving asset, but it's the same as GSCI was. It's the same as the gold ETF was. It's the same as the NASDAQ was when we didn't understand what the it was and why it went up all the time. It's all of these things combined, right?
What do you think about gold here, Raoul?
So I came up with something, it was only last month in Global Macro Investor that kind of shocked me, hadn't figured out, is that there is a set of dominoes that happen in markets. Financial conditions lead everything. For financial conditions, we use the dollar, rates, and oil, right? The three big financial conditions thing. What we found is that leads like the ISM and other stuff by about 9 months. And it leads liquidity by about 6 months, something like that. Liquidity is what drives Bitcoin and NASDAQ, and it leads it by 3 months. So global M2, let's say, leads Bitcoin by about 3 months. I found out, I was like, what's going on with gold? I put it against against financial conditions. It reacts in real time to financial conditions. Wow. I'm like, holy shit, why didn't I figure this out before?
Of all trading securities, right?
Of all the things, well, because it's a pure currency asset, right? It's the pure thing. And so the moment financial conditions ease, gold moves. And so it's leading everything else, which is, we were kind of thinking, is it leading or is it doing something weird? Is it trying to price in some catastrophic risk? No, it was just pricing in the fall in the dollar. The fall, rates didn't really fall a great deal, but the fall in oil.
And I'd throw on, the visible death of fiat currency as, Western nations drive their deficits and their borrowing levels to absurdity. It seems like that's something gold was reacting to on the way up, right?
Well, that's what the financial conditions are in the end. Yeah. It's the debasement of currency. It's the whole thing is the debasement of currency by excess liquidity being pumped into markets by any mechanism possible. At first, they used the balance sheet. Then we all figured that out and called that money printing. So then they did this Fed net liquidity trick, which was the balance sheet plus the Treasury General account and the reverse repo. Yeah. Then we figured that out. And then they moved to total global liquidity, which is including M2, which is stuff it on the bank's balance sheets. So force the banks to buy bonds. That's the game.
Welcome back, everyone, to the Market Chronicles. This is your shortcut to understanding the big picture in finance. We're on episode 21 today, and hey, if you're watching on YouTube, definitely hit that subscribe button. We appreciate it. Today, we're really diving deep into some recent commentary from Raoul Pal. We want to unpack his latest insights on where the markets might be heading, especially with all the geopolitical stuff and macro indicators swirling around, and crucially, what it might mean for you.
Yeah, Pal's been mapping out some potential scenarios. One interesting one focuses on, well, what happens if some major geopolitical tail risks get taken off the table?
Okay, like what specifically?
He mentions things like some kind of deal involving Saudi Arabia, the U.S., Israel, Iran maybe, a ceasefire in Ukraine, China acting, reasonably big stuff.
Right, the major overhangs. So if those ease up, what's his take?
His thesis is that removing that kind of tail risk could actually trigger a pretty significant market rally. He uses the term blow-off, potentially in the next, say, 9 months.
A blow-off rally.
Yeah.
Wow, even with inflation concerns still floating around.
That's the interesting part. He expects that narrative of sticky inflation might linger, even if the actual numbers are falling. So a potential disconnect there.
Okay, so how does crypto fit into this picture for him?
Well, Powell consistently views crypto through a macro lens. It's not in a vacuum.
Right, driven by the same big factors as everything else, liquidity, business cycle.
Exactly. Liquidity cycle, technicals. And he points out that global M2 liquidity, the money supply measure, it's stabilized and actually started rising before Bitcoin really took off again.
Ah, a leading indicator there.
Yeah, and combine that with the sentiment picture, he noted how incredibly negative sentiment got in the NASDAQ tech stocks, basically.
They're really bad.
Comparable to the COVID lows, apparently. So you had this peak pessimism in tech right when liquidity was starting to turn up.
So rising liquidity plus maximum fear.
Powell saw that as, well, almost a no-brainer of an opportunity, as he put it, in both tech and crypto. The feeling was that peak fear was probably behind us.
Makes sense. And looking forward, does he see this strength continuing?
Yeah, he expects markets to remain pretty strong for the rest of the year. The driver. He's looking at forward-looking liquidity.
Meaning what exactly? Things like dollar weakness.
Dollar weakness potentially, and also liquidity coming from other countries' balance sheets feeding into the global system.
And he drew that parallel to the NASDAQ's recovery pattern too, right?
Yes, the V-shaped recovery. He compared it to the rebound after the 1997 Asian crisis. A short, sharp shock where many were caught completely off guard, followed by a strong rally.
So that historical comparison, it kind of underlines the potential risk, or rather, the potential scenario again.
Exactly. If those positive geopolitical outcomes he outlined actually happen, if that tail risk really does evaporate, we could be looking at something like a rerun of the late 90s market environment. 1998, 1999, perhaps.
Okay, let's shift gears a bit. Institutional adoption of crypto. Powell had some insights from the Middle East.
He did. He mentioned hearing that sovereign wealth funds, we're talking Saudi Arabia, Abu Dhabi, Qatar, Bahrain, are now actively buying crypto.
Okay, that's significant. Why now?
The thinking, according to Powell, is that the shift in the U.S. towards becoming more crypto-friendly, or at least clearer on regulation, is being seen as a kind of green light.
The U.S. regulatory environment is key.
It seems so. The expectation is that clearer U.S. rules will give pension funds and the big banks, your Goldmans, your J.P. Morgans, the confidence they need to properly expand their crypto services and allocations.
But it sounds like adoption is still uneven among the big players.
Yeah, he noted that while some big asset managers have crypto divisions, the actual understanding and integration into portfolios, well, it varies. Some are still figuring out exactly how to allocate.
Which sounds familiar, actually.
It does. Powell drew parallels to the early days of commodity indexes like the GSCI or even the first gold ETFs.
Right. Lots of initial skepticism about volatility and how it fits.
Exactly. But eventually, as people understood them better and the frameworks developed, they became pretty standard parts of diversified portfolios. Crypto might be on that same path.
Okay, let's talk gold. Powell had a recent sort of discovery about its behavior.
Yeah, something he's really keyed into recently. He's seeing gold react almost in real time to changing financial conditions.
Like what conditions?
Things like dollar strength or weakness, interest rate moves, oil prices. Gold seems to pick up on these shifts very quickly.
Faster than other indicators.
That's his point. It makes gold a leading indicator compared to, say, the ISM manufacturing data, which lags. It even seems faster than how liquidity changes impact Bitcoin or the NASDAQ.
Why would that be?
His rationale is that gold is essentially a pure currency asset, a global one.
And that ties into the whole fiat currency discussion.
Directly. Powell connects gold's rise to what he bluntly calls the visible death of fiat currency,
Yeah.
driven by, massive government deficits and borrowing, especially in the West.
So the debasement argument.
Pretty much. All the excess liquidity being created, central bank balance sheets expanding, Fed net liquidity, total global liquidity, it erodes the value of fiat currencies. Gold, as this kind of fundamental monetary asset, reacts to that debasement.
Okay, so let's try and summarize the core takeaways from Paul's commentary for you listening.
Well, there's the potential for a serious market rally if these big geopolitical risks fade away. That's a major point.
Right. Then there's the increasing institutional move into crypto, really spurred on by the prospect of clearer U.S. regulation acting as that green light.
And finally, this view of gold as a very sensitive real-time indicator of financial conditions and, maybe more fundamentally, the ongoing debasement of fiat currencies.
A final thought, perhaps, for you to mull over.
Yeah, maybe consider how this web of connections, geopolitics, macro factors like liquidity, institutional shifts, how it all ties together. How might that shape your own view of the opportunities and, of course, the risks in the market over the coming months? What assumptions are you making right now about these big forces?
Some really thought-provoking points there. Thanks for diving deep into Raoul Pal's latest thinking with us today on the Market Chronicles. We'll catch you on the next one.